All the initiatives across marketing, HR, and operations have financial implications. It all needs additional investments. Let us see how it can be financed? Well, you're in the right place. Today we're going to explore the vast world of financing options. We'll touch on topics such as equity financing and maximum stock issue. We'll also discuss dividends per share and both short and long-term debt financing. These can be complex topics, but don't worry, we'll break them down for you. So let's get started. Join us as we delve into these financing options. First up, equity financing. It's a route where you raise capital by selling company shares. The upside? No debt. You're not obligated to repay investors. The downside? Dilution of ownership. As you sell more shares, your stake decreases. Another potential pitfall is the dividend expectation. Shareholders often expect a slice of the profit pie. So that's equity financing, a potent tool for funding your investments. Let's move on to maximum stock issue and dividend per share. The concept of maximum stock issue involves a company issuing the highest number of shares they're allowed under their corporate charter. It's a method of raising capital that can provide significant funding for investments or other expenses. When considering this option, one must remember the potential dilution of ownership that comes with issuing more shares. On the other hand, we have dividend per share. This refers to the amount of money a company pays out to its shareholders from its net profits. The more profitable a company is, the higher its dividend per share can be. However, it's important to note that high dividends can also indicate that a company doesn't have suitable investment opportunities for its profits. In essence, both maximum stock issue and dividend per share can be effective financing options, each with its own benefits and potential downsides. That's maximum stock issue and dividend per share, two more ways to fund your investments. Lastly, we have debt financing. This is a strategy where companies borrow money to fund their operations or investments. It's like taking a loan, where the borrowed money must be paid back with interest over a specified period. Debt financing can be a powerful tool, giving companies the flexibility to expand and innovate without diluting their equity. However, it's not without its risks. Companies must be careful to manage their debt levels carefully. Current debt, for instance, should ideally sit between 0 to 1% of the company's market cap. This ensures that the company isn't over-leveraged and can comfortably service its short-term obligations. Long-term debt, on the other hand, can be slightly higher, ranging from 0 to 2.5% of the market cap. This provides a cushion for long-term projects or investments that may take longer to generate returns. That's debt financing, another viable option for funding your investments. Let's recap what we've learned. We've explored equity financing, the issuance of maximum stocks, and dividends per share as viable options. We've also delved into debt financing, both current and long-term, and how these should ideally be 0 to 1% and 0 to 2.5% of market cap, respectively. By carefully examining these options and creating up to 5 scenarios, we can identify the most strategic and prudent investment strategy. Remember, financial prudence is key in selecting the best option. Happy investing!